we need to talk about why the jobs report today is a bigger deal than ever. It's no longer just bad news is good news. Rather, this jobs report cannot force the Fed to act and start cutting rates right away. Because there is one big problem. Oil is ripping as the Iran war is raging on. And when oil spikes, inflation doesn't politely just fall back down because hiring will slow. And oil drives everything behind inflation. So the debate today isn't can the loss in jobs make the Fed cut rates, and when can they cut rates? Rather, it's this. We already know the Fed cannot cut rates. And now, with the looming risk of rising unemployment, the risk of a recession is getting much higher. So now we even have the risk of not being able to get through this crisis very easily with a clean slowdown. And we have to wait until the inflation fades, and then the Fed can slowly ease into their cuts. But since unemployment is already here, and unemployment rate actually rose in today's jobs report, now we are kind of racing against the clock. And it could be a nasty scenario of stagflation, when the economy is slowing, but prices, aka inflation, keep rising at the same time. And in this kind of a scenario, the Fed cannot act until things just break. So that's the big risk that we are facing and what I want to discuss today. Okay, let's get right into it, and let me briefly explain what this all means. So what is stagflation? So in simple terms, stagflation is a unique challenge that comes every few decades, where you have a combination of slow economic growth, slowing GDP, and slowing jobs, aka people don't have that many jobs, as you see in the jobs report, while at the same time, the inflation numbers are rising. You have rising CPI, rising PCE, and this is a big problem for the Fed, because there is a dual mandate in the Fed where they have to keep unemployment low and inflation low. So they have to help people get more jobs, and they have to make sure that inflation is not too high. Well, back to the current question at hand. Because of the Iran crisis that's going on, we have oil prices that's currently spiking. We have been covering the oil prices over this past week. And when we first started to cover it, it was below 80. Now it's at 93. Even yesterday, we were at 85 range. It's shooting up as we speak. So oil prices directly drive up inflation. It will cause inflation to rise. Not even in the immediate CPI and PCE reports we'll get this next week, but also in the one in April, that will be much higher, because the oil prices we're looking at is the price as of today. And the inflation reports in the US are full reports from the last month. So the numbers we will get next week is about the February numbers. So even if the February numbers are okay, the March numbers will for sure be bad, because when oil prices rise, gas prices rise, transportation rises, and that directly influences things like grocery, food costs, etc. So this has a very fast effect on the economy. So then, because inflation is high, and at the same time, we have Jerome Powell still being at the Fed chair position. He doesn't want to cut rates. And people have already been pricing in no rate cuts from now until at least April, most likely June. So the next two FOMC meetings most likely have no rate cuts. You see, from now until April, 79% chance that we have no cuts. So the scenario that we have been tracking for the last 5 days or 6 days since the war started is just can we go through this period while oil spikes, and as long as oil doesn't spike too much, it doesn't cause a huge panic, and the Fed can delay until the June FOMC meeting, and then maybe we have a small crash, and then they can cut rates. Because by that time, inflation will be very high already. Well, to add on to the pressure is the new jobs report. So the jobs report came out very bad today. Here is what we got. So in the month of February, this is the third time in the past 5 months that payrolls have declined, and it is actually a decrease in jobs. People have lost jobs by 92,000 for the month of February. And this is the largest downwardly revise, because the expectation going into this jobs report was a addition of jobs of 50,000. So there is a big discrepancy there. And this is a big issue because remember, the Fed has two mandates. They have to keep inflation low and they have to keep employment high. Well, employment is dropping clearly, not only in the jobs number, but also in the unemployment rate. So here is the unemployment rate number that came out, which sits at 4.4%. From before this, it was 4.3%. Oh, this is okay. Started to, okay, never mind. So when unemployment rate rises, the Fed usually has to act. Whenever unemployment rate ticks up a little bit, Jerome Powell comes out and says, hey, look, the jobs market is bad, let's cut rates. That's usually what they do. But this time, we don't have that scenario. We don't have a case of bad jobs news leading to good Fed policy, because the Fed cannot act, and the market agrees. Looking at the Fed Watch tool, at this FOMC meeting, 95% chance no cut. Before this jobs report came out yesterday, the percentages were 97%, so barely any change. And same thing in the Fed decision market on poly market, 98% chance no change. You see, even though the jobs numbers were bad, it basically did not move. It went from 99% to 98%. We're not going to get a cut next week. And by the April 29th FOMC meeting, we are most likely not going to get a cut either, currently sitting at 86% chance of no cut. So that's clearly showing that stagflation risk is very high, because usually when jobs numbers are bad, unemployment rises by 0.1%, the Fed acts, but this time around they cannot act. Why is that? That's because of the oil situation we are in. That's from the title of this video. We have the jobs crash. That's the jobs report, which usually prompts the Fed to act. However, at the same time, we have high inflation, because oil prices will lead to high inflation not only for this month, but for next month as well. So this is bad. This is classic stagflation. And why is it bad? It's because since the Fed cannot act, it just gets worse. Looking at the last times that the economy faced stagflation, very similar scenarios in the 1970s. We had two oil crises. We have the Arab oil embargo in 1973, and we had the Iranian Revolution in 1979. Both of these scenarios led to oil prices shooting up, and at the same time, so causing inflation to go up, but at the same time, growth slowing down. And the Fed could not do anything. So you can look at, you can just Google these, But the main takeaway here is people had to line up for oil. There have been a lot of similarities you can point to, something we could face in the coming months. But the difference here is that both 1973 and 1979 were not full-out wars. So here is the chart of the S&P. I'm going to bring up the S&P right here. And the price of oil going back to the 1970s. Down here, you have the price of oil. You see that in 1973, the price of oil shot up from $4 per barrel to $10 within a matter of 1 month. This was very big, 3x increase. And then it didn't come back down. It kept slowly grinding up. All throughout this period, the S&P was in a bear market. And then looking at 79, the price of oil shot up from $15 per barrel to as high as $40 per barrel in a matter of 3 months. No, not 3 months, 15 months. So in both of these scenarios, it was a long, drawn out period where the oil prices kept going up very aggressively. And that is very bad because that is full-on stagflation. Stagflation is a long period where people feel the pain because inflation is high and their oil prices are high, groceries are high, and at the same time, growth is low, so they're losing their jobs. So that usually leads to the S&P, stock market, etc., potentially being bearish. However, the good thing is, right now we are in a conflict. We are in a straight up war conflict, which means this US-Iran war is not likely to last 1 whole year. Even Trump came out and said, hey, we're trying to get this done in 4 to 5 weeks. And all of the Main Street, all the Wall Street firms, like we analyzed yesterday, expect this to be over within 5 to 6 weeks. And they say if it lasts longer than 1 month, things are going to get really bad. So what we are likely to see on the oil prices is a just continued aggressive spike, but hopefully not long-term stagflation. So that's the good thing here in comparison to the last major stagflation period. However, we do have to be ready for a short-term crash. And that's the main thing that we have to worry about. So let's break this down. We have the jobs number that is adding pressure on the unemployment rate. And the unemployment rate currently sits at 4.4% already, having risen 0.1%. I'm going to show you this right here. Unemployment rate 0.4 is the current reading, up from 4.4 is the current reading, up from 4.3. Now, this is bad because if it keeps rising every month, soon we could be heading into a recession. Again, I'm not here to scare you. It's just this number, the unemployment number, is the official number that decides when we are in a recession. Technically speaking, throughout 2022, 2023, the economy was bad enough. But there was no officially declared recession because who decides the recession? The whole process is extremely bureaucratic. I found my video that I wanted to show you guys yesterday. It's this video right here. Why rate cuts and recessions do not matter for Bitcoin. Long story short, there is one entity in the US that decides the business cycles, aka when the economy is expanding and when it is shrinking, or in other words, when are we in a recession. And that's the National Bureau of Economic Research, EMBER. And you can go on their website, and the main thing that they put out is this business cycle dating. You see here unemployment rate and recession since 1948. All of the shaded areas here are their officially declared recession. And you can look at the business cycle dates, and they just say it. They say, here we have contraction in the business cycle, and we have the expansion of the business cycle. And then when we are in contraction, that is recession. So they put it out all here. The problem is these dating, these times are just literally made up by what they decide. That's number one. It does not depend on when a economic indicator changes, like the GDP numbers being negative for 2 quarters in a row, because that has already happened. Or even like unemployment rate reaching a certain number. But what they will do is they always look at the unemployment rate. And that's because this is the chart. It's recession periods mapped on top of unemployment rate. So whenever unemployment rate goes up very quickly and it does not stop, they have to justify it by saying, hey guys, we have a recession. So that's number one. You don't want to read into it too much and say, because unemployment rises at a certain level, all of a sudden we have a recession, we have to panic. Number two reason is that, and the really messed up part is that whenever the EMBER, this agency, releases one of these announcements right here, these are the dates, saying that they have determined that the business cycle has ended and we had a recession. Look at this one, July 19th, 2021. That is after the recession has already completed. And you can go ahead and watch this video I did from 2024. Basically, I've mapped out on the dates that the actual recessionary period that they said was there, and then which date did they come out and announce the thing. And usually, when they actually announce the thing is already over. So that's the crazy part. This is completely bureaucratic of a process, and it's used to justify their actions in a retroactive way. You cannot trade with it. So don't panic thinking about this recession. Once you hear of the news, you should sell. Quite the contrary. Whenever you hear that the official recession is here, usually that's when you want to buy. Okay, so big caveat there. But back to our analysis on the jobs report earlier. We do have to worry about this because on this jobs report, unemployment rate did inch up from 4.3% to 4.4%. But the Fed cannot act because, like we said earlier, the inflation is also very high. So because the Fed cannot act from now until at least June, when you look at the Fed decision probabilities and the CME Fed Watch tool, all signs are pointing to Jerome Powell not acting, and maybe Kevin Warsh can act in June at a lower probability, about 40% chance. What this means is unemployment rate can continue to rise. And that's bad. If unemployment rate continues to rise, like this kind of pattern, 0.1% every month, that's going to be pretty bad. And that's the real risk here, is when unemployment rate rises, people have higher and higher fears of a recession. And that will be a very heavy pressure on the markets. So that's the main thing that makes this situation even worse on the markets, because the markets is what we care about. From now until June, there are now two scenarios that add to this market shock. Number one is the rising price in oil. So when you have a rising price in oil, right here, what happens? Well, we covered it already. When oil prices rise, inflation is very high. It immediately leads to inflation being very high. And that leads to Fed cannot cut rates. And because the Fed cannot cut rates, bond yields will spike. Stock prices tend to drop in the short term until, and obviously, risk assets like Bitcoin will get hit because in crisis scenarios, Bitcoin is more heavily correlated to risk on assets like stocks, less so to gold. And these things can only recover after oil prices come down and inflation comes down a couple months after that. Once we have the inflation numbers, then the Fed can retroactively act, start cutting rates again, and then S&P and Bitcoin can recover. And this is why also when people look at the S&P, they say, hey, there's going to be a short-term crash, but the markets will recover usually 3 months after the wartime finishes. Because 3 months is enough time to say the war is done, oil supply lines get resolved, oil prices come down, and then that leads to inflation numbers coming down in the months after that when the inflation report comes out in CPI and PCE. And then the months after that, the Fed can act. So usually there's a delay there, and that's when the stock market rebounds higher. So this was already the case with a potential risk we could see, which is something like this. Oil prices keep spiking, and a lot of the index fund firms give it some kind of a scenario like this, assuming a 35% rise in oil prices to reflect a sustained Strait of Hormuz disruption, that could drag US equities down something like 13% and strengthen the dollar before it can eventually rebound. So this is coming directly from MSCI, the big index provider and research firm. So something like this, where you have, let me map this over here, pin to scale Z, boom. You have oil prices shoot up, S&P gap down, something like 13%. That would be pretty big, actually. Maybe from the top. Okay. Going into last year's levels before rebounding, let's say 3 months later, while oil prices are shooting up. And most Wall Street firms tend to agree that if the conflict drags on 3 weeks longer, so total of 4 weeks at least, oil prices should hit $100, which is enough to cause this. And we are ahead of schedule on oil prices because oil prices is already at 93 on the 7th day of the conflict. So this is probably going to happen, this short-term market panic. You can also look at the VIX, which is the volatility index for the US stock market. And usually this is a great signal to watch whenever the VIX breaks up. S&P sees a short-term panic before later on it rebounds. So we are about to break out on the VIX. So be ready for this. But on top of this, we also have the other side, which is the unemployment. This is the nasty one, because while all of this pressure coming from the oil is adding on to the panic, the unemployment number is also rising. So here is the unemployment number at 4.4%. This number is bad because the jobs numbers are not going to improve. Remember, the jobs number here that we got is for the month of February. This is pre-conflict. This conflict started at the end of February. So most of this job loss did not come during a time of war. So what are we going to have next month? We don't know. Maybe we have a weird scenario where more jobs come in. I don't know, maybe. But this is scary. And so now we have two sides. We have both the oil panic and we have the unemployment panic. And both scenarios add to the Fed being harder to act. And if the two come together, it can really force a recession to happen in the short term. So that's something we don't want, okay? Because if they have to use their final card with this bureaucratic thing, this Ember and comes out and says, hey guys, we have a recession during this period. That is the worst case scenario, because that's when they run out of all tools and they have to admit we lost control. And that usually means the market have already gone down a lot. So be wary of this. This is the big thing that we have to be careful to not have happen. Okay, so how do we act right now? There are two numbers to follow coming up next week, which maybe provide some relief. And those are the inflation numbers for February. So here we have the CPI, and the next CPI report comes out on March 11th. Both the CPI and core PCE will come out next week, March 11th and March 13th. These two are inflation numbers for the month of February. Yes, for last month. And CPI comes out first. CPI is less important, however, but as you see in these two numbers, CPI has been falling, which tells us that inflation has been going down. This is good. We don't want inflation to start rising already in the early months of February, because that's pre-Iran conflict, pre-oil price spike. If it already was going up, that only means the next CPI is going to be worse. It's going to be even higher. And same thing for core PCE. This is the number that the Fed cares about. Core PCE is what they reference in the FOMC meetings to compare with their target inflation rate. And currently, for the month of February, that is already at 3%. It's kind of bad. We want the March report to be under control. We want it to be not too high. Again, they don't have the forecast yet. The goal here is just to have it at the same level as the forecast. If it's already higher than the forecast, that means they missed their mark. It has already risen. And we already know that the April number is going to be bad because higher oil price leads to inflation. So we know that the April number for core PCE and CPI is going to be higher than the one we have last month and this month. It's just how much higher. So watch for these two numbers. Hopefully they can come out as the same numbers as the forecast, so then people won't panic as bad. But regardless, these two numbers will rise by the April readings. So be prepared for that. And what will all this mean on the markets? So the stock market, gold, and Bitcoin. So the key to watch here is still how quickly this conflict can resolve itself. Two scenarios. If the conflict slows down very quickly and oil prices can actually come down, things will be better, because then that means we have a inflation under control, and the Fed just has to navigate the next two FOMC meetings, the March and the April, without cutting. And then by June, they can try to cut. But if oil prices continue to stay high, and if the war continues to rage on for the next I can't even imagine how many weeks because we're only 1 week and we are already at 93. So if it lasts the whole 4 weeks, oil prices are going to be very high. That means inflation numbers for the April CPI and PCE is going to be extremely high. And that means the Fed cannot cut very easily. And they probably will even, not even what they will actually do, but the market will start to price in a lower and lower probability for them to cut in June, and then for the subsequent cuts in July, even for August. And that will be bad. That will be a lot of headwind for the market. So the key here is the faster we can reach de-escalation in the Iran war, the better, because we need oil prices to come down. And on the other hand, unemployment. We don't want the unemployment number to keep rising. Okay, unemployment rate is at 4.4% now. The longer and more consistent that the unemployment number rises, the closer we get to the inevitable recession. We know a recession will come because this is a business cycle and we are near the end stages of the business cycle. It's just a matter of when does the unemployment rate go up very quickly and things get out of control and the bureaucrats have to come out and say, hey, we saw a recession. Because when that happens, the market has already been very bad. So if inflation, if oil prices continue to stay high, causing inflation to be very high for the next couple months, and then trapping the Fed so that they cannot cut in the June FOMC when Kevin Walsh comes in, then that could be a long time. Think about it, like 3 more months of unemployment rising. And if unemployment rises by 0.1% every month, that's going to look pretty bad because we will have a new higher high on the unemployment rate. See here, the unemployment rate, the highest point that we reached was 4.5% in the last 3 years. If this breaks out again, if we are at 4.7% by June, that will be pretty bad. And then if the Fed cannot cut, if Kevin Walsh, the new Fed chair, cannot cut by June, then we have to wait all the way until Jackson Hole. So Jackson Hole is the annual Fed speech where they get all of the people who matter in finance. They gather together in Kansas City, and the Fed chair comes out and make a big speech about what he wants to do for the next year. So usually this is when the new Fed chair can tell everyone what he wants to do. And if Kevin Walsh is to cut more aggressively and use QE, he has a chance to declare that in late August. So we want all of this to be resolved and for inflation to at least be somewhat under control by late August so that he can announce something. For example, this is last year's speech by Jerome Powell, Monetary Policy and the Fed's Framework Review in late August 2025, which laid out what he wants to do for the year ahead. So Kevin Walsh is going to say something, put out his whole piece in August. This is really what I expect the Fed to make a pivot. If they're going to do so in a meaningful way and have especially QE, because QE is a multiple months type of thing that they have to commit to instead of just month after month, like the interest rates. They have to do so with a plan, and probably they have to do so in the Jackson Hole meeting. So we have to last until then. And be prepared if inflation numbers continue to be bad because oil prices continue to rise, and at the same time, because the Fed cannot cut in the short term at all, then maybe unemployment will continue to rise until August. Then that's going to be bad. This is probably in my mind, as I have been tracking the recession risk, etc. Probably the highest risk period that we have had since 2023, since post-COVID, since the major rate hike period. So be careful. Again, I'm not trying to use the recession word as a panic signal, because remember, rate cuts and recession, the official declarations are not actionable events. If there is a recession that's being declared, that will be after the markets have already crashed and prices have already come down, especially on the S&P. Here's the chart of the S&P that I have used to compare with the previous recessions. And you see here, for example, in 2001, this is the recessionary period that they said that the economy was in contraction, and you see markets have already come down. And then this is when they said that the recession started, and this is when they said the recession was already over. So markets would have already been way lower. So just be careful. You have to do so, navigate the next few months, not trying to track the news cycles around the recession, around the stagflation, etc. But rather you have to understand that we are in a stalemate in the Fed. The Fed cannot act. And no matter what numbers you see on, so the numbers that will matter is really the oil price, because the oil price drives everything right now. If the oil price continues to go up, that means the war will not end. That means the Strait of Hormuz is still closed. And this is really an oil-driven war. And if that happens, inflation will be high, so you don't even have to wait for the PCE numbers and the CPI numbers to come out. And on the other hand, unemployment number is what you want to track, but you don't want to worry about it too much, because everybody already knows unemployment number will be bad. But that doesn't mean the recession will be declared right away. The recession declaration is usually after the fact that it has already passed, after the market has already crashed. So the key here to watch is still, can oil prices come down? When can the ceasefire come? When do we have a ceasefire, and when can the oil prices drop? And that's why everyone's watching the oil price right now. If we have a 4-week long war and the Strait of Hormuz stay closed, oil prices is for sure going to head above 100. And that's the trigger point that most of the Wall Street analysts are apparently telling their investors that it's going to be pretty bad for the markets, and you will see some de-risking from S&P, from even the Bitcoin ETFs. And then we will see if oil prices get higher, there's going to be more de-risking. So just be prepared for that. And then back to the charts. For example, MSCI, okay, scenario analysis. MSCI says a 35% rise in oil prices. Let's say that's from the beginning of the conflict. Beginning of the conflict, 35% rise leads to 98, just under 100. So let's say they're talking about like 100. If oil prices rises to 100, wow, that's actually pretty scary. We have to give them more leeway even. So maybe that since the time that they published this article, this investor scenario analysis. That's March 3rd. So let's say from March 3rd here, oil price average on that day was $81, and then you map it to 35% higher, 110. So let's say oil reaches 110 per barrel, which, I mean, on this chart doesn't even look that crazy if we have 3 more weeks. So hypothetically, if this is reached, MSCI, one of the main index leaders, says that could drag US equities down 13%, which is something like S&P going from March 3rd prices right around here, 13%, going to basically summer 2025 levels down here. That's pretty bad. Imagine what this will do to Bitcoin. It's not just 13% anymore. It's 20 to 30%. And that's the kind of scenario that could lead us to, visit the bear market panic lows. So here's a chart of Bitcoin. Here is the 200-week SMA at 58,000. Let's say we have another, 25% down. Boom, 50K. I mean, if the S&P draws down 13%, Bitcoin is going to be down more than that. 25% is totally reasonable. So you have to be ready for this. I'm not saying this has to happen. For all we know, I'm not an expert on oil. Oil price can just come down, and then this scenario can not play out. But you have to give it some leeway. You have to give it some probability. We have plenty of time here. It's only been 1 week. Remember, if we have 35 days of this entire conflict, can this head so high? You can look at the daily chart. That's going to be more obvious. This conflict has been on the 7th day. If we have another 28 days, what's the probability for oil to head up here? It's decently high. So just be realistic, be careful. And remember, I'm not particularly bearish on Bitcoin just because I think Bitcoin is in a bear market and whatever, and bear market has to go a certain percentage, whatever. It doesn't really matter. What matters is the oil price and risk on appetite for assets. If the S&P, if nobody wants to buy the S&P, everyone wants to flood into gold. Obviously, we can try to convince ourselves that Bitcoin is going to follow gold. And to some extent, it can. There is a wildcard scenario there, but that's not my base case. The base case here is still for Bitcoin to behave like a risk-on asset. And when the S&P reacts to that kind of Fed panic, because the Fed is fully trapped, inflation is high because oil price is spiking, and unemployment is also high. So the Fed is not able to act until much later. So then the S&P draws down. You have to be ready for Bitcoin to follow the S&P and all other risk-on assets to have a drawdown. And I'm not even just talking about the S&P specifically and then Bitcoin. You have to be ready for other equities to come down, other risk-on assets. So it's really a market-wide thing. So be ready for that. If Bitcoin comes down 25%, low 50Ks, have your cash ready to be DCAing. But then again, I'm not looking to short this at all. I will continue to hold my Bitcoin, but my portfolio will be totally okay if Bitcoin goes from 68K to 50K and then recovers later on. If the S&P sees a big drawdown because all the risk-on markets are panicking. Okay, that's a scenario that I'm willing to stomach, and that's something I'm ready for this next month. All right, That's it. Thank you guys for joining the live stream, and I will see you on the next video. Cheers. Bye bye.